Hello everyone, warm welcome to Regulatory Bodies YouTube channel by Testbook. My name is Madhav Sir. I welcome you all in the next session, that is basically finance current affairs. We know this very well that if you are preparing for regulatory bodies exam or for that matter any other bank exams, finance current affairs is going to play a really very important role. Keeping that in mind, we at Testbook brings to you a session, or I would say a series of session, where we generally discuss in detail the current affairs related to the financial sector. In this particular session, we discuss the RBI latest reports, RBI press release, we discuss the RBI latest circulars, even we discuss the RBI bulletin and the RBI latest annual reports. So before I start with the discussion, can you please let me know in the comment section that I am audible, visible, everything is fine, we are good to go, so that we can start the discussion without any further delay. Do reply in the comment section, please. Today, my agenda of this session is pretty clear and pretty, I would say, concise, because today in this particular session, we will be discussing in detail. About a very important report, that is Financial Stability Report. I'm pretty sure you must have heard about this particular report. Maybe some of you have read about this particular report, or maybe some of you have even watched some of the videos on this particular report. But I assure you, after watching this session, all your doubts related to the Financial Stability Report and all the important data or facts and figures which are important for your upcoming examination will be discussed in this single session, in this single video itself. So let's get started, guys. But before I start, I'm really very sorry I've not even shared the link of this session with our students. So I'll just do it, and I request you to do it same with me. So quickly copy the link of this session, share it with your friends, so that more and more students, they can join us live in this particular session. I assure you guys, after this session, you will be going home by taking bare minimum 4 to 6 marks for your phase 2 examination and bare minimum 2 to 4 marks for your phase 1 exam, because this report is damn important report for your upcoming examination. Not only the facts and figures, but I would say the understanding of the report is also important. The analysis of the report is also important. Some of the statements which are given in this report, they are really very important, which helps you to analyze pretty well that how your financial sector is doing currently. So let's get started, guys. Chalo, let's get started. So first of all, I'll start my discussion, as I basically said that I will be discussing about the Financial Stability Report. So before we discuss the Financial Stability Report December 2024, let's find out what actually Financial Stability Report is. So first agenda of this session would be what is Financial Stability Report. Then we'll discuss the latest Financial Stability Report, which is going to help you a lot. So let's get started. The first point, when we say what is Financial Stability Report, you must remember first thing that Financial Stability Report, it's a report, it's an RBI publication which is published twice a year, which means it is published 2 times in a year. Basically it's a, I would say, report which is published biannually, which means first it is published in June and second it is published in December. So from this you need to understand one point very carefully, that this report comes up with the data, but this data is more of calendar based data rather than financial year data. What I'm trying to say, June report will discuss or will share the financial stability from January to June, and obviously December report will talk about July to December. So what is the reason? So the reason is quite obvious, because this report is not only presenting the financial stability status of India, but it is also talking about, or it is also discussing the financial stability of the entire globe. So I'll start my discussion in this manner that financial stability report, it is released by RBI, this we know, and it is released biannually. That means it is released twice in a year. This report is prepared by whom? So this report is prepared by Financial Stability Unit and Subcommittee of Financial Stability, Subcommittee on Financial Stability and Development Council. I don't know whether you are aware of this term or not. First, let's discuss this and then we'll bounce back. So if I ask you what is Financial Stability and Development Council, so Financial Stability and Development Council is non-statutory. Non-statutory means it is not mentioned under any act. It's a non-statutory apex council which has been set up under the Ministry of Finance, and this particular council is headed by the chairman of this particular council is whom? So the chairman of this particular council is Finance Minister of India. Not only this, additional secretaries as well as secretaries from Ministry of Finance and many other ministries, they are the part of this particular council. Not only this, Governor of RBI, not only this, along with this we have Governor of RBI. Now you must be wondering, that's a governor ka hona to zaruri tha. That's not the case, but along with Governor of RBI, I would say Chairman of SEBI, I would say Chairman of IRDAI, I would say Chairman of PFRD. I would say the major financial regulators of the country, their heads are also the members of this particular council. They are also the members of this particular council. Now you must be wondering, so this council is responsible to prepare the financial stability report along with RBI? No, sir. If you have read the statement quite clearly, it says subcommittee. It says subcommittee of the financial stability and development council. Remember that this subcommittee comprises of members from all the financial regulators, but the point is this subcommittee, that is Financial Stability and Development Council, it is headed by Governor of RBI. It is headed by whom? So it is headed by Governor of RBI. So along with Financial Stability Unit and subcommittee of what? So subcommittee of Financial Stability and Development Council. Remember that Raghuram Rajan Committee on Financial Sector Reforms had first proposed setting up of this FSDC, and after this FSDC was set up, and basically this organization, this council is responsible to share their thoughts, their understandings as well as their calculations about the global economy and the Indian economy, on the basis of which they comes up with the prospect that how our economy is going to perform in the near future. Coming back to the point from where we started, so Financial Stability Report was first published in which year? So first it was published in 2010, and after that it has been published on regular basis. So report takes input from the financial sector regulators such as RBI. It takes inputs from obviously SEBI, IRDAI, PFRDA, even Ministry of Finance. So this report assesses the financial system resilience and the risk to financial stability. This is very important. So what is the agenda of this particular report? So the agenda of this report is, this report will identify the risk to the financial stability of the economy, and even this report will assess that how stable the Indian economy is. How stable the Indian economy is. This is the overall agenda and the concept of Financial Stability Report. Is it clear till this point? Good evening everyone. Good evening Shruti, Mukund, Pratima, Sayantani, Shubhra and Parmeshwar. Good evening everyone. I hope till this point whatever we have discussed is crystal clear, and if it is crystal clear, just give me yes sir so that I can move ahead. If it is crystal clear, just give me yes sir so that I can move ahead if all the points are clear till this point. Now moving on to the next. If I move on to the next statement, the next is current report. If I talk about the current report, so it is the December 2024 report, obviously released by which organizations. A financial stability report is released by RBI over, as well as I'll say it is a half yearly publication of RBI that is known as Financial Stability Report. This report shows the joint assessment. Again, this point is mentioned. This report shows joint assessment of Subcommittee of Financial Stability and Development Council about the potential risk to the financial stability and resilience of the Indian financial system. So it basically identifies what are the potential risks which can impact the financial stability of the Indian economy, and even it will talk about the current stability, the current capacity or capability of nations. What? So nations financial stability. Nations financial stability. Is it clear till this point, guys? Is it clear till this point? If it is clear, just give me yes, sir. Now, let's get started with the current report. I assure you the current report is going to be very helpful for you guys. And what is this current report all about we are discussing? So the current report starts with a very important opening statement, and I'll start my discussion with the same. So the report has covered international as well as domestic economic conditions, the performance of scheduled commercial banks, non-banking financial companies, and the solvency of the insurance sector. So from here, first thing which you need to know that this report which we are talking right now, this report has reviewed international as well as domestic stability. Along with that, it has analyzed pretty well the performance of scheduled commercial banks, NBFCs, as well as solvency of insurance sector. Every time this assessment is done, but this time the international assessment was pretty important. Why international assessment was pretty important? The reason is very clear. I hope you all will agree to me. Due to the geopolitical tensions which is going on, which started from Russia, Ukraine, and now it has involved Syria, Iran, Iraq, and whatnot, even Israel. So this geopolitical tension is undoubtedly impacting the stability of global economy. And due to the impact on the stability of global economy, it will have its implication on the Indian economy as well. So keeping this in mind, government, or I would say the officials who have prepared this particular report, they have analyzed the international conditions pretty well. And while analyzing this international condition pretty well, they talked about a term, normalization of monetary policy. They talked about a term, normalization of monetary policy, and even they talk about, along with normalization of monetary policy, they have talked about the accommodative stance as well. So what I'm trying to say, if you remember, we know that in India we target a control inflation range of 4% plus minus 2%, that is 2 to 6%. If that is a scenario of 2 to 6%, if the inflation rates are not within the control range, for that we have monetary policy as well as we have fiscal policy. So in the past, we have witnessed that due to the international, or I would say the geopolitical tensions, inflation, or I would say global inflation has increased, and this global inflation has impacted, or it has pushed the RBI to change its policy rates. But undoubtedly RBI has not revised its policy rates, and for long years RBI, I would say for last long year, RBI has maintained its policy rates same, or I would say I'm using a word constant. Now in this particular scenario, over the period of time, as global economy, I'll not say that it has stabilized, but yes, inflation rates are falling, or inflation, the rate by which inflation is increasing, that means introduction of disinflation has raised a question of concern for the economists all around the globe, and the governments, they are taking required steps. As you remember, if you remember, Federal Reserves has reduced its policy rates when we were looking forward that yes, RBI will also reduce its policy rate maybe in October. That was not done. Then we were pretty sure that RBI will do that in December, but again that was not done. But yes, RBI has reduced cash reserve ratio in order to increase the money supply in the market. So that is what we say normalization of monetary policy, where RBI is trying to get loose on the monetary policy to increase the money supply in the market, so that the Q2 dent on the GDP growth rate can be overcome in the next quarters to come. Is it clear till this point? Is it clear? Now, so this, if I talk about this particular report, so this report has observed the strength of the scheduled commercial banks. Before I read this, you know this very well that Indian scheduled commercial banks are performing pretty well. If you have heard about, or if you have watched my previous session, that is progress trends. If you remember, I have discussed that the scheduled commercial banks of the country are doing really very well, and even in the parliament, it was a very clear statement given that we are not thinking of further merger of the public sector banks, because yes, the public sector banks, they are performing well. They are strong enough because they have the adequate reserves. They have pretty low NPAs, and they are strong enough to survive in the near future. So along with this strong banking sector, what else or what other data have been recorded which are important? So please pay attention. According to IMF and World Bank, if we talk about the global forecast, that how global GDP is going to increase in 2024, it is expected to increase by 4.2%, for which, sir, it is for the emerging development economies, and for advanced economies this growth is going to be 1.8%. But if I don't confuse you in all these things, then I can say simple: global economy will grow 3.2% according to IMF, and it will grow around 2.6 and 2.7% according to World Bank. If you ask me what is this A, so this is advanced economies. What is EMDE? That is emerging development economies. For them, different growth rates are given, but for you, if you want to write an answer and clear the examination, you must at least remember the global growth projections given by IMF as well as World Bank. After talking about the global growth prospectors, the next point which you need to remember is growth prospect for India. If I talk about the growth prospects for India, as per RBI's financial stability report, the Indian economy has demonstrated strength and resilience. If I talk about strength, that is true. Why it is true? Because from past few financial years, I would say just after COVID, Indian economy has given a V-curve recovery, which means the way or the fast Indian economy fell down, with the same rate, with the same, I would say, speed, it has grown as well. So this V-curve recovery was witnessed. Along with this V-curve recovery, our exports are increasing, our fiscal deficits are decreasing, and government is increasing tie-ups with the international economies for, I would say, for domestic currency settlement, which will decrease our dependency on the foreign currency, which will add on to the further stability and strength to the Indian economy. So keeping all those things in mind, it says that yes, Indian economy has demonstrated strength and resilience, according to which we are expecting that India's GDP is going to grow at 6.6% in the current financial year, that is 2024-25. So this is very important. Phase 1 favorite question of the examiner. As per financial stability report presented by RBI in December 2024, what is the GDP growth estimates for India? Answer is pretty simple, pretty okay. That is 6.6%, which you need to remember. The next point talks about the report has outlined the growth will mainly be driven by the resurgence. So what are the reasons of this growth? So the reason of this growth is rural consumption. Why this part is important? Let's suppose there is a question in finance and management paper 3 in your phase 2 examination, and that too a descriptive question. Indian economy is growing. Indian economy is growing at a decent rate, but quarter 2 of the financial year 2024-25 was bit dent. Now government is expecting, or the report shows that its economy is going to flourish back in quarter 3 and quarter 4. What are the reasons? So what are the reasons? The first point where we talk about that what are the reasons? In the first point, I would say quarter 3 witnessed, or we are expecting a great growth in the quarter 3. Reason is festive season. Along with that, we have marriage season, which increases private consumption. Now, if I talk about the fourth quarter shows expectation in terms of rural consumption because of harvesting of crops, increase in government spending and investment, robust service exports, declining NPA, and adequate capital and liquidity buffers are the overall reasons of growth for Indian economy. But in quarter 4, what we are witnessing is, or what we are expecting is, good agriculture season will increase the rural consumption, and this rural consumption will ultimately push the Indian economy for sure, along with, if it is going to be well supported with service exports. There is a question for you which you will be replying me after this session with figures, actual figures. India is one of the leading exporter in the service sector. Highest service sector exports are recorded to which sector, or highest service exports are related to which sector? For example, it is related to hospitality sector. It is related to, I would say, transportation services. It is related to IT services, or it is related to any other service sector. So you just check and give me the percentage that out of the total service export, 49 or maybe 51 or maybe 53% of exports belongs to which sector? You need to reply that in the comment section after this video. Moving on to the next point. This is just for your knowledge. Do not remember it. It says that the report highlighted India's GDP moderated 6% during the first half, and now we are expecting 8.2 and 8.1. I would say India growth rate was 6% in the first half of the financial year, that is 2025, which was 8.2% in last year, and in last year in the second half it was 8.2%. Let's see what is going to happen this time. So the report noted that despite this latest declaration, India's structural growth drivers remains intact, and we will be for sure achieving the overall GDP growth rate of 6.6%. This point is important, which you need to remember. Central government debt to GDP ratio is expected to decrease. It is expected to decrease to 56.8% from 62.7%. State outstanding liabilities are projected to decline from 31% to 28.8% during the same period. If you remember, FRBM Act 2003 was presented. Later on, there was a committee set up under the chairmanship of N.K. Singh, and that committee published the report, and that report targeted that government should decrease its fiscal deficit to 4.5% of GDP in financial year 2024-25. And second point is government should decrease its debt to GDP ratio. That should be 60%. That should be 60%. But this condition, or I would say this figure, is need to be achieved by 2025-26. Out of this, 40% will be center government borrowing and 20% should be state government borrowing. So these are the target which government is chasing. And yes, we are improving, or we have improved a lot as per the targets given. We have improved a lot as per the targets given. Okay, I admit that point, Parmeshwar and Abhinav, that yes, IT services is correct. But I have asked you the percentage as well. What percent of the total services is exported from IT sector? Then do reply that as well. Moving on to the next point. So the report has highlighted India's external commercial borrowing, which has reached $65.49 billion, which is nearly 34.4% of the total debt, which has increased in the recent times. It has also mentioned that increase in foreign currency borrowing by NBFCs could pose currency risk to the extent they are unhedged. What is this? NBFCs, they are borrowing from the foreign parties. The borrowing which is done from the foreign party is known as external commercial borrowing, and let's say the borrowing is done in US dollars. The moment borrowing is done in US dollars, it is utilized by NBFCs in order to make the spending in India itself. Now, if this borrowing and then the investment done, if this investment is not hedged, there is a probability of loss, and if this loss is witnessed, it will impact the entire stability of the NBFC sector. That is what is being discussed. So if I say out of the total debt which is borrowed, out of the total external debt which is borrowed, 34.4% of the total debt is what? So that is unhedged. That means unhedged means it is unsecured. Hedging basically means what? Sir, hedging का मतलब क्या होता है? Hedging का मतलब है, for example, if I am borrowing loan and I have to repay back the loan, let's say after 3 years, and I'm pretty sure after 3 years exchange rate of the currency is going to change, and if I sign an agreement with a third party that whatsoever is going to be the exchange rate after 3 years, I will be making the exchange on the current rates. This is known as hedging. So hedging is a risk mitigation technique, and if external commercial borrowing is done and that too unhedged, it may impact the stability of that particular sector or the entire economy in the near future. So this report has also highlighted about the NPS in the retail loan portfolio, which is led by the slippages in the unsecured loan book at 51.9%. So this report has also talked about that the retail loan portfolios which were led by slippages in the unsecured loan has been recorded around 51.9% in September 2024. Moving to the next point. The next point we have liquidity coverage ratio. If you remember, in Basel III, liquidity coverage ratio was introduced. Then we have net stable funding ratio was introduced. Leverage ratio was introduced. So what is liquidity coverage ratio? So liquidity coverage ratio basically means high quality liquid asset of the bank, divided by net cash outflow of bank in 30 calendar days during stress period. So when there is a stress period, in that particular scenario, bank will be witnessing net cash outflow. So in order to support that cash outflow, bank should possess high quality liquid asset, and this ratio should be greater than or equals to 100% as per BIS, as per Basel Norm 3. But in India, it has been recorded that this, if I talk about the liquidity coverage ratio of the banks, it is 128.5% as of September 2024. Undoubtedly, it has declined as per the previous. Rates, but still it is, I would say, marginally above. Still, it is marginally above the required targets. Got it? Moving on to the next point. The report has underscored that overall performance of listed private non-financial companies has remained stable in 2024 as the sales growth year on year remained 6.2% in the first half and we are witnessing a growth in the near future as well. We are witnessing the growth in the near future as well. Is it clear, everyone? Now, one thing you must remember that, sir, if liquidity coverage ratio has decreased, what basically it shows? It shows that there is a decrease. This decrease in mainly because increase in the net cash outflow, which is further influenced by increase in less stable source of funding. So we have witnessed the decrease in this percentage. This decrease in percentage is because of, first, expectation of increase in this cash flow wala part, and next is decrease in the high quality liquid asset, because of which 135% has reduced to 128%, which is important for you, which you need to remember. Moving on to the next point, monetary penalties were imposed, and monetary penalties from June to November have been imposed. If I talk about these monetary policies, monetary penalties which are charged by RBI. Why RBI charge the penalties? And if banks, they do not, or banks, NBFCs, CICs, or I would say all the organizations which are regulated by RBI, if they do not follow the RBI norms, they do not fulfill the compliances, then RBI has a power, potential to charge penalty on them. And in that particular case, RBI has charged penalty from June to November. This penalty has decreased by 47%, and the total penalty value is 30 crore rupees, which was 57 crore for the same period in the previous year. Out of this, total 153 monetary penalties were charged, and these 153 monetary penalties include 5 public sector banks as well as 5 private banks. Then we have 3 foreign banks, 2 regional banks, 116 cooperative banks, 14 NBFCs. If you ask me, 153 is important. 5 public sector bank, 5 private sector bank, 47% decrease, 30 crores, 57 crore. At least this part is very, very important, along with this foreign bank. Rest you can ignore. No one is going to ask you. Undoubtedly, if direct question is asked, so direct question is expected from this paragraph, but this data can be utilized in your descriptive answer writing to justify your understanding related to the current RBI norms, RBI policies. As per December 2023, 2024, the liquidity deficit stood at 2.43 trillion rupees, which is driven by tax outflow and central bank foreign exchange interventions. Can you give me this answer? What is liquidity deficit? 2.43 basically means, if I'm not wrong, trillion basically means 10 to the power 12, guys. Please guide me if I'm wrong. Guys, please guide me if I'm wrong. And if this is correct, this means, if this is correct, this means 2, 4, 3, 2 and 3 into 10 to the power 7, which means 2,43,000 crore rupees is the fiscal deficit as of December 2023. So liquidity deficit means, what is liquidity deficit? Can you explain the term liquidity deficit? Anyone? Can you explain this term? Liquidity deficit in the economy is around 2.4 lakh crore rupees, and it is just because of the tax outflows and central banks foreign exchange interventions. So this is going to be your homework to reply in the comment section after this session, that what is liquidity deficit. This is the status of the banking sector, where we have the gross advances of the banking sector, we have gross NPA percentage, we have net NPA percentage, we have return on asset, we have capital adequacy ratio, we have liquidity coverage ratio, then we have slippage annualized, which is slippage which has been provided in the annual format, that is known as slippage annualized. This is the entire data. Now, obviously, it's very tough to understand the data in this manner. Don't worry, I have the detailed version of the same. We have read this n number of times that India's NPA is all-time low. Gross NPA is 2.6% and net NPA is below 1%. So the stress test scenario has further projected that the gross NPA could possibly increase to 3% by March 2026 for 46 banks under the baseline scenario, and 5% or maybe 5.35% under the two different high risk scenarios. So whenever we calculate the NPA expectations, we go with risk scenarios. If I talk about the stress test, as per the stress test, NPA, gross NPA will increase to 3% expected by March 2026. But on the basis of the other risk inclusions, the target is as high as 5.5% and 5.35%. So this is the data which you need to remember. This is the projection. This is much important for March 2026. You can ignore this, but this is important. Moving to the next part, if I talk about the net NPA, so that is 0.6%. If I talk about CAR, that is capital adequacy ratio, it is 16.5%. It could decrease to 16.5% in March 2026 and to 15.7% and 14.3% as per the scenario. What is the current CAR? So the current CAR is 16.6%. I hope you all know that capital adequacy ratio. So capital adequacy ratio basically means capital divided by risk weighted asset. Capital means bank's capital, which include bank's equity, bank's preference share investment, funds raised by bank through debt instruments. It include bank reserves, it include bank's profits and all. So the capital of the bank divided by risk weighted asset. What is risk weighted asset? So it is sum of expected risk. It is sum of expected risk on every asset. It is sum of expected risk on every asset of the bank. So when we calculate the expected risk on every asset and then we add those risks, we get what? So we get RWA, and the moment we divide capital to RWA, this ratio should be at least 8% as per BIS. As per RBI, it should be 9%. On the other side, capital conservation buffer should be 2.5% of RWA. But in India, capital adequacy ratio is 16.6%, which is way higher than the minimum requirement, but it will fall under the normal conditions to 16.5%, and under subnormal conditions it may even fall down to 15.7 and 14.3%. So okay, so but why can federal keep the rates so low but India cannot? It is because it will reduce FDI as well as FDI as we have a developing economy. No, if India is decreasing the rates as of Federal Reserves, first of all, it will result in outflow. It will result in outflow of foreign currency. It will result in outflow of foreign currency because due to the decrease in Federal Reserves, undoubtedly expectations is said that American or US economy is going to grow. If it is going to grow, then everyone will invest in the US economy so that they can earn pretty high returns. So in that particular scenario, on one side we are expecting high returns in US. On the other side, if RBI has decreased its repo rate, bank deposit rates will decrease. Then a rate of interest paid by the banks on the deposits like FCNR and many other deposits, so that amount will again go into US for better returns rather than India. Most of the debt instruments, they will witness low returns. Again, that amount will flow out of the country. That is the reason India cannot decrease the rates pretty easily, first thing. Secondly, this decrease in rate will impact the exchange rate of the currency. Third point is, in comparison to US, India is in more stable scenario. That is the reason there was no much requirement, or I would say there was no emergency situation witnessed in India to decrease these rates in order to stabilize the economy. Banking system liquidity being in deficit means bank don't have sufficient funds for the credit demand coming in from the customers. Okay. So this is your homework, Rohit Raj. I'm still expecting more replies. Once I'll get Guys, am I audible now? Okay, fine. So let's quickly complete this discussion. So the points we have discussed, that is done. Okay. Moving on to the next point. What does the next point says? So provisioning coverage ratio of scheduled commercial bank has increased to 77% in September 2024, mainly due to the proactive provisioning by public sector bank. We know that what is provisioning. So when a loan is declared as NPA, and even before the loan is declared as NPA, it is known as standard asset. After declaration of NPA for the first 12 months, it will be termed as substandard asset. After 12 months, it will be termed as doubtful asset. Then after the announcement or declaration done by the internal or external auditors, it will be declared as loss asset. So for every category of asset or the category in which your loan is, bank maintains a provisioning, bank maintains a reserve. So this reserve has been accounted, that is 77%, which is capable enough, or I would say which would be capable enough for the banks to survive in the tough times, which will be for sure capable enough for the banks to survive in the tough times. Moving to the next point, 3 banks continue to display risky metrics. So the report shows that starting, if I talk about the starting of the 2014, three-fourth, that means 75% out of 33 public sector and private sector banks, they are examined under the key risk indicator framework and were found deficit in 3 or more KRIs. So what are these KRIs you are talking about? If I talk about these KRIs, what I'm basically focusing on, sir, KRI, basically the framework which was introduced by IMF, which means vulnerability of the banks. And how we measure the vulnerability of the banks? So we measure the vulnerability of the banks on the basis of capital adequacy, asset quality, management, earnings, liquidity, and system. So 75% of public sector banks and private banks, they are showing weak, or I would say they are showing vulnerable for more than 3 KRIs out of the given, that is capital adequacy, asset quality, management, earning, liquidity, and system. But on the other side, one thing is also more important, that RBI presently conduct the supervision on the basis of what, sir? It is on the basis of risk super. It is known as risk supervision, but earlier RBI was carrying out its supervision on the CAMELS framework. So these KRIs include what? Capital adequacy, asset quality, profit, liquidity, and market metrics. So out of these 5 matrices, 75% of the banks, they are not performing well for 3 or more than 3 matrices. So the report noted that only 3 banks, which means accounting 15% of the total banking system, have been found to be deficit in 3 KRIs in 2024 despite sector-wide improvement. So we have witnessed that yes, sir, there has been sector-wise witness, but still this scenario which shows that back in 2014, when 75% of the public sector and private banks, they were failing to achieve at least 3 KRIs out of 5, but as per the latest report, we say 15% of the total banking system asset have been found to be deficit in 3 KRIs in September 2024. If I talk about the loan sector, so loan sector has registered a growth of 13.4%. This is important. Along with that, if I talk about the investment reported lower growth, what is the investment growth rate? 7.6%. If I talk about the combined, this is 11.2%. This is again a low growth rate which has been witnessed. Last part is, report has noted that increase in bank profits as well as increase in equity capital has significant additional source of fund which contributed to an increase in loan deposit ratio. So banks loan deposit ratio has increased, which is a positive sign. It has been also observed that bank reliance on borrowings for bridging the financial gap has increased, which is impacting, or which is adding on in a positive manner for the economic growth, and it is pushing the Indian economy to new heights. Last but not the least is, what is gross NPA? You must know that. What is net NPA? You must know that. What is CAR? You must know that. If I say gross NPA, Gross NPA basically means loan which is declared NPA divided by total loan provided by the bank into 100. And what is net NPA? So gross NPA minus provisioning is known as net NPA. It is basically termed as net NPA. As the name suggests, net NPA is the remaining amount after bank has deducted the provisioning from doubtful and unpaid debt from the total gross NPA. So I hope these terms are crystal clear to you. PCR, if you remember, provisioning, I just mentioned over here, provisioning coverage ratio. Provisioning coverage ratio is what, sir? It is the percentage of funds that a bank set aside for covering losses due to bad debts, which is kept for standard assets, it is kept for substandard asset, and it is increased as the asset changes its category. So this is all you need to remember related to the financial stability report. I assure you guys, if you have covered this entire report, you will be in a position to answer all the questions related to the same in the examination. What you need to do is just scan this QR code, because in the after the last session I witnessed your comments in the video section as well as on different channels. You were commenting regarding the PDF. Just download, or I would say just scan this code. You will able to join my Telegram channel, and I will be sharing the PDF of this session on that particular channel itself. If you memorize this report and its data, I can assure you, you will be in a position to answer most of the questions in your examination. So that will be all from my side, guys. Quickly join our Lakshya batch in order to assure 100% selection in your upcoming RBI Grade B examination. Use code MADHAV in order to ensure 100% selection and maximum discount. Thank you so much. Good luck. God bless you all. See you. Sorry for the disturbance. The class got stuck in between due to some technical issue, but I hope now it's fine. Good luck. Bye-bye. Take care.